Let me ask you a direct question. If you hold an overseas bank account, a rental property abroad, or crypto on a foreign exchange, are you absolutely certain that HMRC doesn't already have information about it? Because in 2026, the idea that offshore means invisible is no longer realistic. The UK participates in financial data exchange with more than 100 jurisdictions worldwide. That means overseas banks, investment platforms, and increasingly crypto providers are sharing data with tax authorities, and that data can make its way to HMRC. It's not about fear. This is about understanding the environment we now operate in. Today, I'm going to explain how HMRC receives overseas financial data, how its system called Connect identifies discrepancies, what triggers a nudge letter, and what should you do if you have something which isn't declared. Because the biggest risk today isn't holding overseas assets, it's assuming no one can see them. Before we go any further, let me introduce myself. I'm Imad Ilyas, one of the partners at Churchill Tax Advisors. In the past few years, we have seen a sharp increase in cases involving overseas accounts, overseas properties, and digital assets. Not because the clients intended to do something wrong, but because the reporting landscape has changed dramatically. And that's exactly what we're going to unpack today. The foundation of modern international tax transparency is the Common Reporting Standard. Under CRS, financial institutions in over 100 participating jurisdictions automatically exchange account information with tax authorities each year. If you're a UK tax resident and hold an account overseas, that institution may report your name and address, your tax identification number, your account balance, interest income, any dividends received, and proceeds from certain asset disposal. Overseas property can also enter HMRC's visibility through multiple channels. If you sell a property abroad and the proceeds are deposited into a reportable financial account, that transaction may form part of CRS reporting. If rental income is paid into an overseas bank account, that income can be reflected in the data shared with HMRC. In addition, international cooperation between tax authorities has expanded significantly. Property ownership abroad, particularly where income is generated or gains are realized, is increasingly difficult to keep outside HMRC's reporting framework. Holding property abroad is not the issue. Failing to report the income or gains associated with it is the issue. That information is transmitted to the local tax authority and then shared with HM Revenue and Customs. This is no longer a manual suspicion-based request system. It's all done automatically. The United States operates a similar system under Foreign Account Tax Compliance Act, often referred to as FATCA. So if you hold a US-based financial asset, that data may also be reportable. The key point is this: the information flow is systematic. The question is not whether reporting exists, it's whether your UK tax return reflects it accurately. Receiving data is one thing. Using it effectively is another. Connect cross-references tax returns against large volumes of third-party data. This can include financial information received from CRS, UK property transactions, company directorship data, investment disclosures, publicly available information. Connect is designed to identify inconsistencies. For example, if CRS data shows income from foreign source, but no corresponding rental income or capital gain appears on a UK return, that discrepancy can prompt review. Similarly, where lifestyle indicators suggest overseas asset ownership inconsistent with declared income, that can also generate a risk flag. If overseas income appears in international reporting but does not appear on your self-assessment tax return, the system may generate a risk flag. That does not automatically mean wrongdoing, but it can prompt further review. Often the first letter is what's called a nudge letter. A few years ago, many assumed crypto assets operated outside traditional reporting systems. This assumption is becoming increasingly outdated. The OECD has introduced the Crypto Asset Reporting Framework, often referred to as CARF. Its purpose is to bring digital asset transactions into a similar reporting structure as traditional financial accounts. As implementation progresses, crypto exchanges and service providers in participating jurisdictions are expected to collect and report customer data to HMRC. In parallel, HMRC has increased compliance activity relating to crypto transactions, particularly where capital gains or income have not been declared. The overall direction is clear. Digital assets are moving into the same transparency framework as traditional assets. Again, the issue is not ownership, it's accurate reporting. Offshore non-compliance carries enhanced penalties under UK law. Where HMRC identifies undeclared offshore income, penalties can be significantly higher than purely domestic errors. Depending on behavior classification, careless, deliberate, or deliberate and concealed, penalties can reach up to 100% or in some cases 200% of the tax due. There are also requirements to correct provisions which apply to historic offshore matters. In addition to penalties, interest accrues from the original due date. In serious cases, HMRC may publish details of deliberate defaulters. Now, it's important to emphasize most cases we see are not criminal, they are disclosure failures, often involving inherited overseas accounts, rental income from foreign property, small amounts of foreign interest, historic assets retained after moving to the UK. But even small discrepancies can become expensive if left unaddressed. If you believe something has not been declared correctly, the worst strategy is delay. The UK provides formal routes for voluntary disclosure, including the Worldwide Disclosure Facility. Making a disclosure before HMRC opens a formal inquiry generally results in lower penalties and more controlled process. Timing is critical. Once a formal investigation begins, your flexibility narrows. Proactive correction demonstrates cooperation and can significantly reduce your financial exposure. At this stage, many people try to handle matters themselves. This can be a mistake. Offshore disclosure requires careful assessment of behavior classification, penalty mitigation strategy, historical exposure, documentation review, and timing of submission. Every word in a voluntary disclosure carries weight. If you would like a confidential review of your overseas reporting position, you can speak directly with a specialist at Churchill Tax Advisors. We assess your exposure, outline your options, and guide you through the appropriate disclosure routes where necessary. Details are provided below. The era of financial invisibility has ended through the Common Reporting Standard, advanced analytics like Connect, and expanding digital asset reporting frameworks. International transparency is now embedded in the system. If you hold overseas accounts or assets, the most important question is simple. Does your UK tax reporting fully reflect them? If you're unsure, seek clarity sooner rather than later, because in offshore matters, uncertainty is expensive, but correction is possible. Thank you for watching.